Well, good afternoon, all, and good morning to those customers joining us from Hawaii. Thank you for joining our latest installment in our new Harvesting Value webinar series. Our goal with this monthly series is to provide you with information and resources to help make important decisions at your operations. My name is Brandon Souza, and I'm the head of marketing at American AgCredit, and also from a family farming operation in California Central Valley. So I find these webinars equally interesting and informative. Before we dive into our commodity update presentation, I'd like to remind everyone of a few housekeeping items. You're welcome to submit questions for our terrain analyst during any time during the presentation by using the Q&A feature on your Zoom taskbar. We will do our best to address as many questions as possible at the end of the webinar and follow up on those which we might not have time to get to. Additionally, this presentation will be recorded and we will share a link to the webinar with all of the attendees afterwards. If American AgCredit is new to you, we've been part of the farm credit system for more than 100 years, and we have the most diverse commodity portfolio in farm credit, which allows us to adopt and evolve ag finance best practices and innovation across different types of agriculture. With such a diverse portfolio, we recognize that each agriculture sector has its unique challenges and opportunities. Today's presentation will begin with a macroeconomic overview of factors currently impacting the agricultural economy, and then we will dive into top takeaways that you should know for your specific commodity market. Today, you will hear takeaways for wine grape, grains, beef cattle, dairy, and specialty crops. Our presenters for today join us from Terrain. Terrain is a complimentary offering for all customers of American AgCredit, and if you're interested in receiving notifications for new content from Terrain, you can scan the QR code that you see on your screen here, or visit agloan.com/terrain to opt in for email notifications on when those reports are available. Today, our first speaker is Terrain's Senior Rural Economic Analyst, Matt Clark. Matt focuses his energy on the impacts of interest rates, land values, and other macroeconomic trends in agriculture. Matt's previous work experience includes being an economist at the Federal Reserve Bank of Kansas City. Thank you for joining us this afternoon, Matt. I will go ahead and let you get started with your portion of the webinar.
Thank you, Brandon, and good afternoon to most of you, and good morning to those who are out in Hawaii. I titled this presentation, Numbers Worth Following, and the reason I did that is because I think most of you are probably like me in the sense that every day you open up your news app or your newspaper if you still get one, or you turn on the TV and there's 100 different news reports that are coming out, each with a different take. And for me personally, when I think about the economy and when I think about impacts on farming, when I think about impacts on interest rates, which we'll talk about today, I'm trying to hone in on just a few very key metrics, and I thought I would try to share those with this group. The first thing I think it's important to do is to follow the money. What do I mean by that? Well, just this last week, we got a report that US GDP growth was a little bit slower. It was 1.6%. Now, again, that's a growth formula. It's an annualized type number, but that was slower than what we previously had experienced, certainly in the back half of 23. My contention, though, still is if we're thinking about the economy as a whole, we're still set up for what I would consider to be solid to good growth. Now, not great growth. I think we're probably past our peak GDP here recently in 2023, certainly. But I do think we're set up fairly well. And I say that because of this follow the money metric. The chart you're looking at here has a number of things. First, it's got that kind of bright blue line, which is private employee compensation and supplement payments. So that would include things like medical insurance or dental insurance, eye insurance, those kind of things that would fall into a employee's compensation packet. It's also got the red line, which is proprietor's income and business transfers. So that would be like kind of a small business metric. And then the purple line, which is the corporate profits. Let's focus on those three first. These are inflation-adjusted numbers that I'm looking at as a percent change from previous year. All of these numbers, or all three of those, are positive. All three of those are positive. Now, small businesses have been slower to recover compared to some of our large corporates and compared to how well the consumer's done. But still, all of those are positive. And if you think about the confluence of all three of those positive numbers, you really kind of have to go back to a period from about 2017 through 19 when we last saw that run, which was, all things considered, a pretty good run for the economy. It's rare to see all of those kind of flowing together. Typically, when they flow together positive, in combination with that yellow line, which is real disposable income, so the real amount of income that we have available to us as consumers, when you see those things all run positive, generally you have solid economic growth, which the way I look at it, and this green line here, is we probably are past peak growth that we saw in the back half of 23, but I do expect still GDP to be strong, or at least trend or above trend for the next several quarters in 2024. I don't think that you see a massive decline or any sort of negative numbers coming forth unless there's some major black swan. Some of that is also set up by the next slide, which is the labor market. As I mentioned in the previous slide, if you look at the growth in income, it's been strong. So too have been the hiring rates that we've seen. Again, there's a lot of, I would say, buzz or misinformation about labor markets. Often you see headlines about layoffs. Those are real people. Those are real issues. We don't mean to belittle those. But if you look at some of the aggregate numbers on the labor situation, it is overall strong. So you've got quit rates, 2.2%. That is down from where we were in 22 and 3, but still it's in the top 35% since 2001. It's about at where we were pre-COVID. Same thing with the number of jobs available per unemployed person. Again, down a little from where we were, but still in the top 10% and roughly where we were pre-COVID. My personal favorite metric, if you think about the total jobs that are being worked, total jobs available, divided by that working age population number, that number has continued to grow, and it's in the top 1% of where we've been since 01, all indicating a pretty strong labor market. You see this reflected in some of the high frequency data, such as continued and initial unemployment claims, which have really been fairly stagnant since, about August of 2023. You've seen those be really flat, all roughly around those pre-COVID numbers. So it's the strong labor market. The downside to the story that I'm developing here so far, where you've got a good economic foundation to grow, you've got a strong labor market, is obviously this next slide. And this is where we get into the inflation story, which has frankly been, it's been stickier and it's been more difficult than we thought it would be for quite some period of time. Again, when it comes to inflation, there's hundreds of different inflation metrics. The news bounces around from one to the other. But this is the number, or these are the numbers I like to follow here, where it's the trim mean CPI, the median CPI, so the middle inside of that CPI bucket, and the trim mean PC. All three of these try to get at this idea of what's the middle of the basket doing. Is inflation declining? Is it increasing? Where are we at? You'll notice the news focused most heavily on that kind of blue line here, that trim mean CPI, which actually increased a little bit here in the last March report. Likewise, the median CPI, though less pronounced, flattened out. You saw it too with the PCE report that just came out last Friday. I didn't have time to put it into this chart, but again, PCE actually increased compared to the previous months. And so you've got a scenario where inflation is not only sticky, but actually increasing some. The next slide kind of gives another way of thinking about this. For the Fed to actually lower interest rates, it's going to need to see some progress on this inflation metric. So here's a different way of thinking about inflation, where typically we look at it that year over year bucket, which is on your left here. We can also think about as inflation declining or increasing based on the last 6 months, last 3 months, or the last month. And the story here is that there really isn't a story that gives you an idea that inflation is declining towards that 2% dotted line, which is the Fed's stated goal. As such, you have a Fed that is committed and has been indicating that they were willing to commit to keeping interest rates higher longer to combat inflation. The next slide, though, kind of gives a different take on this, just to kind of understand how the consumer thinks about this. What I showed you so far is the nerdy math behind inflation, and when we think about Fed hikes or cuts, this is how we actually experience inflation. Typically, we talk about that blue line, that year-over-year line. But if you think about inflation for consumers, us, we typically tend to think about it more that green or that purple line, where we don't think about prices just a year ago. We think about, well, gosh, 4 years ago, 3 years ago, how much did diapers cost? How much did, how much did my basic produce cost? How much did gas cost? How much did a cup of coffee cost? We think about it in terms of bigger picture than just a year-over-year metric that the Fed would report. In this case, if you'll notice, inflation by these metrics, or a 4 or a 3-year change, is closer to some of the levels we've experienced in 1980, which in my mind is why you see the Fed being committed to fight inflation, and why you see consumer sentiment or consumer reports indicating a much weaker economy than the data would otherwise say, meaning we all feel this inflation in a very different manner. As such, I do think the sentiment is slightly less than what the hard data would say on the economy. So most importantly on this last one, what does this mean for interest rates? This is a chart I was developing here a while ago, and while I was developing it, my Spotify podcast brought up a song called "A Hard Price to Pay," which is a favorite of a bluegrass band of mine. And I thought that seemed like a fitting title. As the year has developed, inflation has in some cases accelerated, or you could make the argument has accelerated by a number of different metrics. As such, you've seen the Fed become very stalwart in this idea that we will not cut rates until we see inflation slow to our goal. The market has reacted to that sort of rhetoric. So that blue line there is how many cuts the market thought we would have, going all the way back to January 2024, where the market thought 150, 175 type cuts. If you go back to my previous articles, my previous webinar, I was pretty clear that I thought the market was way in front of where we were going. Over time, as inflation has remained sticky, you've seen the market slowly come closer to that kind of green line there, which was the Fed's March forecast. Recently, that red line would show that the market actually thinks we will cut less than the Fed thought we would, which would be 3 25 basis point cuts or 75 cuts in 2024. My view is thus, I think when I step back and I look at the data, there is a plausible case for the Fed to cut as the year goes on in 2024. However, I don't think it's going to be soon, and I don't think it's going to be nearly as strong as what the market had previously thought. Personal guess is you do see the Fed in kind of that second half of 2024 cut interest rates, or the Fed funds rate. I don't think it's going to be 3 cuts. I think it's going to be less than that. It could be 2, somewhere around that nature, unless some major black swan happens. What that means for you as the borrower is twofold. First, you will see that kind of immediate sort of change in some of your more variable interest rates. And then you'll see a slight decline in some of those longer rate numbers should we get some cuts. It won't be full force, but it will be close. That's kind of my side of this. I'm going to turn it back to you, Brandon, so that we can move on towards the commodity piece.
Well, thank you for that overview, Matt. If you hang with us until the end of the webinar, we will address a few questions attendees may have submitted at the end of the presentation. Our next presenter is Dr. Chris Bitter, who is going to dive into his top 3 takeaways for the wine, grape, and vineyard sector. Chris?
Thank you, Brandon. So 2023 was a challenging year for California grape growers, and there's a lot of uncertainty about what's going to happen going forward. So today I'm going to take the next 5 minutes to share with you the top 3 things that I think grape growers should be looking at in order to get a better sense for where the grape market is heading in 2024 and beyond. So the first and most important is the trajectory of wine sales. So ultimately, retail wine sales drive demand for grapes. And the figures here show the change in sales over the last 12 months in volume terms. And as you can see, sales have been declining across the board, across price points, and across sales channels. So the outlook is still very uncertain in terms of what's going to happen next. And that's mainly because the pandemic created a lot of distortions in the wine market. Now, those distortions are starting to fade into the rearview mirror. So the new normal for wine sales should become more apparent as 2024 progresses. So if we see sales begin to stabilize, that's going to be a really positive sign. And we should see demand for grapes eventually start to firm up as well. But if they don't begin to improve soon, then we have to accept the fact that we're in the midst of a secular decline in wine sales and declining wine consumption in the United States. In that case, we're going to need fewer grapes over time, not more. So I think by the end of this year, we're going to have a much better idea of what it is that we're up against. So the second thing to watch is progress on inventory and this should say destocking, not restocking, progress on inventory destocking. So in the aftermath of the pandemic, wine inventory levels swelled across retail and the wholesale sectors. And that was because retailers and wholesalers didn't anticipate the decline in wine sales that we've seen over the last couple of years. So this chart here shows the inventory to sales ratio for alcoholic beverage wholesalers. And you could see first a drawdown during the pandemic and then a big spike thereafter. And there hasn't been much improvement since, and we're still sitting near all-time highs. So the problem with this is that distributors don't need to buy as much wine from wineries because they're selling through their own stocks. So wineries in turn don't have to produce as much wine, which means they don't need as many grapes. So that's obviously a problem for grape growers. But once inventories begin to come back in line to more normal levels, we should see demand for grapes begin to firm up. So that's what we should be watching for this year. Now, I will mention that it's going to be a temporary boost, and over the long run, it's really the retail sales that are going to drive the bus in terms of wine demand. And then last but not least, the third thing I want to talk about is the pace of vineyard removals. So even under an optimistic scenario for wine sales, we have too much grape acreage in California to support favorable prices to growers. So that problem was masked by short crops between 2020 and 2022. But last year, the crop rebounded. We were in the normal range again, perhaps a little bit larger, and the market choked on it. And we actually saw a lot of fruit that was left behind on the vine simply because there weren't any buyers. So vineyards are going to need to be pulled to restore the balance between supply and demand and start to see stronger increases in grape prices again. So the figures here on this last slide come from allied grape growers. It is their estimates of how much acreage needs to be removed by region. Now, I haven't actually confirmed these with my own analysis, but I do believe these numbers to be in the ballpark. So we're talking about 50,000 acres total, which is almost 10% of the bearing acreage in California today. So it's quite a bit that needs to be removed. So if we see rapid progress for these targets, we could see the grape market begin to firm up within a year or two. But if progress is slow, then the market's likely to remain depressed for some time yet. So one of the problems with tracking this, though, is that nobody systematically tracks vineyard removals. So you're going to have to keep your eyes and ears open to gauge the pace of vineyard removals in your respective region. So with that, those are my top 3 things to watch in 2024. Next slide, please. And this story is obviously much more nuanced than I can get across in 5 minutes here. So I do want to invite you, if you're looking for more detailed insights as well as updates frequently on what's going on in the wine and grape markets, please read our new quarterly wine industry publication called Winescape. If you scan the QR code here, you can download the latest issue as well as sign up to receive notifications when future issues are released. And thank you all for joining us today. And with that, I'll turn it back to Brandon.
Thank you, Chris, for those insights. I know Winescape has been a welcome addition to the industry, so I would encourage people to download that report. If you have any questions so far, please drop those in the Q&A feature, and we will invite our analysts back at the end of the webinar for some answers. Next up is an update on our tree nut and vegetable crop analyst from Terrain Specialty Crop Group, Dr. Matt Wolf. Matt, we'll turn it over to you.
Hey everyone. So today I just want to talk about 3 underrated trends in specialty crop production. So specialty crops is a pretty broad term that encompasses a whole bunch of different commodities. And so I'm going to try to make this as broad as possible and really try to focus on 3 underrated trends that I see impacting both the Central Valley as well as the Salinas Valley. So the first one is there's been a bit of a reversal in roles between nut crops and vegetable crops. And so I created this index of nut prices and vegetable prices from 1990 onwards. And it'd be no surprise to growers in the Central Valley that there's been this incredible run of nut prices. That's kind of gone in the opposite direction since the pandemic, particularly with almonds and walnuts, where there's been this buildup of inventory, which has put downward pressure on prices. Meanwhile, vegetable prices for the most part have sort of hung in there, with some commodities even going up quite a bit. So I include processing tomatoes here, where the price has gone up quite a bit. I think what's interesting about this trend is that we're seeing it impacting what's going on with regards to plantings. So we've seen plantings of all nut commodities in California really drop down, while a lot of the vegetable acreage has gone up. And I think this has, an impact on all these markets. And as we think about the implementation of SGMA, which makes permanent plantings maybe a bit riskier given the water situation, I'm asking myself whether this is a trend that's going to continue. So I think this is just underrated in the sense that we don't often think in these terms. Often we're kind of siloed in our own markets, but this is potentially something that's going to change the future crop mix of California. The next underrated trend is on the ag tech side. So I think most growers have had some experience with ag tech of some kind. I think if you talk to most growers, they tell you that there's a lot out there that is very much overrated in terms of how it will impact things at the farm level. However, I think it's important to keep in mind that Western growers did a survey the last few years of respondents who are investing in automation, and what we're seeing is that fewer and fewer growers, at least as a percentage of the total, are investing nothing in automation, and the percentage that's investing, $1 million to $2 million is actually on the rise. And so I think this is something that growers should be aware of. We might not think of ag tech as something that's happening super quickly or happening at all, but that adoption is very much happening, if not, it's just slower than what might be expected, particularly when we think of the tech space and how quickly adoption can happen. The next trend is just the incredible rise in regulatory costs in California. I think all producers are well aware that regulatory costs in California are high and that they've been increasing in the last decade or so. But I think even then, this is an underrated trend when we look at some of the percentages and really break down where some of those regulatory cost hikes are coming from. So looking at this graph, this is comparing the 2012 regulatory costs with the 2018 regulatory costs this is from a survey done by some Cal Poly professors. You can see that the capital investment to be compliant with California regulations have gone up over 500%. The Food Safety Modernization Act, which had a big impact on the Salinas Valley, has gone up almost 550%. And so, again, even though this is something that's not new to California producers, I think it's something that's underrated. I'll also just mention that I think a lot of this is going to continue when we think about the implementation of SGMA and things like GSA fees, and then also some of the broader legislation out there with regards to clean fleet rules, California emissions reporting. I think it's really vital to consider what these sorts of pieces of legislation, how they're going to impact the farmer at the end of the day, and possibly be passed on to the farmer. And so just to summarize there, I think these are three underrated trends. Number one is the shift we're seeing in the crop mix given the change in relative prices. Number two is the adoption of ag tech, which is very much happening, if not just slowly. And then number three, the incredible rise in regulatory costs of being an agricultural producer in California, which even if we're aware of it, it's been quite an incredible increase and likely to continue. And now I'll pass it over to Brandon.
Thanks for sharing those takeaways, Matt. Our next presenter will be Terrain's oilseed analyst, Cody Barilla, for some insights into the grain sector.
Hey, thanks, Brandon. We can just jump right into that first slide. We're going to try to cover the corn, soybeans, and wheat market in 5 minutes. So this first slide is driving the corn market today. So hone in on the green bars at the bottom of the slide. If you take a look at that, that is our stocks to use number. So that would be our corn inventory here in the US divided by total usage. So focus on 2020, 21, 22. 10% or less, right? Also look at 2010 through 2013. What's the similarities there? Tight stocks, high corn prices. When we switch gears and look at that 2014 through 2019 timeframe, higher stocks to use, 13 through 16%, also lower corn prices, right? So I wanted to take a look at what happens when we make this transition from a tight scenario into a more abundant corn scenario. So if we roll to the next one. So the last time we made this transition was when we switched from the 2013 to the 2014 year. So that blue line there is the December 2014 corn contract. And you can see we started the year at $4.50, trended up to about $5 during that planting period. At that point, the market started to feel comfortable with planting pace, weather conditions in the US, and total acreage. And from there, it slid all the way down into the low $3. And from that, we finished the year sub $4. So it brings up this point, how is this year different? And this is why I'm presenting this. I don't know that we have differences this year. So when you think about corn demand, ethanol demand, it's static right now. We don't have any story to increase that demand bucket. Feed demand, static. There's no big story to drive increased demand in US corn usage through feed. Export demand, yes, we've picked up a little bit, but that's largely driven by a cheaper corn price today. So really, we're going to be banking on a drought here in the US or South America if you're in the camp that we go back to $6 plus corn prices. Personally, I am going to hedge a little bit, protect myself from the downside, because I don't have a story that prevents us from having a very similar price trend as our 2014 contract. So I've been very aggressive on December 24 corn. I've even started to sell some December 25 corn. It closed today at $4.86. Maybe profitable prices for some producers. That's something to look at. But as you think about this corn market and you're just asking yourself, how did we get from $6 plus corn to where we are today in the low fours? If you flip to the next slide, Travis Kelce was actually telling us in the Super Bowl what happened. Let's go to the next one. Soybean market is acting very similar. On the world front, ample supplies globally. Think about the top three exporters: US, Brazil, Argentina. Brazil just came off of a good crop. Their crop is in the bin. Market feels comfortable with it. The Argentina production is double what it was last year. And here in the US, acreage is up 3 million acres compared to last year. That's what we're projecting. So there's not a tight supply story on the soybean front. And also bearish news, when you look at US soybean prices, we are uncompetitive compared to Brazil and Argentina right now. Let's take a look at wheat real quick. So on the wheat front, we're actually eating through global stocks, but the problem we have is the Black Sea continues to pump out very inexpensive wheat that's supplying the world. When you look at US production, exports continue to decline. If you flip to the next slide, we're at 52-year lows on exports, and it's unlikely to change in the near future. The value of the US dollar is incredibly strong right now. So we are at a loss when it comes to our competitors in Russia that are increasing acreage and increasing yield, and they've got a cheap ruble. So they're making money even at these lower price levels. Continue to the next slide. So wrapping this up, this is the slide that nobody would have predicted. Black Sea production continues to increase even during the midst of a war. Russia's increasing acres, we're outcompeted. And if you finish with the last slide, exports are the same way. So as you can see in the background of my picture, that is Western Kansas wheat today. There is some bullish news, and it's drove these wheat prices up about 70 cents from their recent lows, driven by not only Western Kansas wheat concerns, but also Russian concerns. So those are the things that I'm going to be looking at here in the near future. Please don't leave a blank space in the Q&A, and I'll pass it back to you, Brandon.
Thank you, Cody. We will now hear a dairy market update from Ben Lane. Ben is the senior dairy analyst with Terrain. Ben.
Yeah, thanks, Brandon. Hello, everybody. So I want to take the next few minutes to try and go through what I would consider three big themes they've really been developing over the past couple of years and kind of converging in 2024 as some of the major drivers of price movements that we're keeping an eye on. So the first one is milk production, or really kind of the lack thereof. We've plateaued starting in 2021, kind of leveled off in terms of the volume of milk that we're producing. And if you go back, I mean, you could even probably go back farther than this, but even just looking here from 2010, we pretty predictably grew by 1.5% year over year every single year. And maybe one year it's 1.7, the next year it's 1.3, but that was a pretty stable trend year after year after year until we hit 2021. And basically for the past 3 years, we've made the same amount of milk each year. We've barely grown at all. In fact, this year, 2024, we're starting the first quarter down 1% year over year. So in a normal situation, we might expect that tightened supply, that lower supply should be driving milk prices up. And we saw that in 2022, kind of the first year that we paused and didn't see the normal rate of increase. Prices did increase, and it was a really strong year for milk prices. The difficult part is that 2023, again, we made the same amount of milk, but prices were much more depressed. So we weren't able to sustain that strength just on the virtues of kind of a tight supply situation. And the reason that we saw that difference is on the next slide. And the key that changed things was about exports. So domestic demand has been pretty stable throughout, more or less, but the export situation has changed pretty dramatically. So 2022, when we had really good prices, we had strong year-over-year growth in export levels. And that was against 2021 and 2020, which were also really good years for exports. We hit the brakes in 2023. We saw those export levels, the volumes of export decline pretty dramatically. And so as we, as an industry, start to rely more on exports as our opportunity for growth, and we've seen that we're usually around anywhere between 15 to 20% of our production of milk in the US that gets exported. When that slows down, it starts to back up product into the US. It weighs on our prices, and that's what we felt in 2023. Still continuing into 2024, again, we're still seeing those prices lower than we'd like to see them. It's been a rough start, at least on the class 3 and the cheese side, but I'm hopeful that we might be starting to see things turn around. And we did see that in February. We saw really strong year-over-year growth, particularly in terms of cheese demand from Mexico. We saw really strong, and they've been pretty strong throughout, but it's encouraging to see things move back in the right direction. It's 1 month. It's a little early to be calling that a complete reversal of this trend, but I think we are lined up in a situation where we're priced competitively compared to our global competitors, the EU and New Zealand. We're at a discount to those cheese prices. So we are potentially going to start seeing more sales being booked, longer term export contracts being locked in. I'm hopeful that we can keep that momentum moving into the second half of 2024, and that will help lift prices again, because we still are it's going to take time to get that milk production growing again. It's going to be tough to rebuild that. So if we can start see demand come back on the export side in particular, that'll be positive for prices. And the next slide, kind of the third factor that's going to be part of that is the new cheese capacity that's coming online. And so there's a number of cheese plants in the next couple of years that are going to be taking anywhere from 5 to 10 million pounds of milk per day, largely because we had seen those cheese exports growing. Everybody started making more cheese plants to help serve some of these markets. And so now we're really going to need to see those exports come back. But I think the interesting thing here to keep in mind is a couple of things. one, it's encouraging to see investment taking place in the industry. So it's not just cheese plants either. I don't have other plants shown on this map, but there are other investments in fluid milk plants, other dairy product processing plants. There's a lot of investment going on in the dairy processing sector, which is good because it's going to need more milk. It's going to allow for some expansion. I think in the near term, especially with some of these cheese plants, you're going to see some competition for milk. They're going to need to find milk to fill these plants. That could add some regional and near-term premiums to milk, and a situation where we haven't seen anyone competing to buy milk in a while. So that should be a welcome change. The flip side of that is, again, we're going to be making a lot of cheese from these plants. And so we're going to need those exports to come back. We're going to need them to remain strong. I do think that long term, that will be the case. I think that's the long-term growth potential for the industry here in the US. And it's not terribly out of line with the trend line over a few year time frame once we add these plants. But in the near term, I do think it will limit a little bit to the upside, the potential for cheese prices and class 3 milk price, just because we're going to have plenty of it for the time being as these plants come online. So those are the things that I'm keeping an eye on, and I will hand it back to Brandon. Thanks.
It seems like our friend Brandon's having some audio trouble, so I'm going to take off with this. And Jill, if you want to hit the next slide for us, we'll get back in line while he gets audio straightened out. I'll have to admit, this is a National Enquirer style headline. I wanted to get folks' attentions on where we're at from a beef cow and a heifer standpoint. It says no females left to quickly rebuild. That's true. When we think about what we did last year, in terms of in 2023, breeding heifers to calve this spring. We had a limited number down versus the year prior, working on being headed towards cycle lows. But we also didn't keep very many heifers back. In the last 3 months, we've seen heifer placements into feed yards continue at an aggressive liquidation style pace. And of those heifers that we designated as beef replacements, we've seen with prices, quite a few of those actually head into the feed yard over the last month or two, as producers look at what's going on in the marketplace, the potential for profitability, that they were thinking they'd make a couple $100, maybe $300 per head, taking a risk, breeding a few more heifers than they'd actually needed for their own operation, and marketing those in the fall. Their profit expectation got met, selling those heifers into the feeding market. And there's a lot of factors going into that. Prices for one, weather is another we'll look at here in a minute. And those things are kind of pushing more females into the feed yards. When we look at what's going on the chart, January heifers a percent of cattle on feed, we're back to essentially the early 2000s kind of levels. And when we look at that, the beef cow herd culling rate compared to 2000 is down 2% as well. So we're not retaining females very well in the cow herd. If we look at beef cow slaughter the last couple of years, we've liquidated a lot of cows that way. That continues. We had poor reproductive performance last year, especially in the northern plains. So we're seeing a lot of herd dispersals. Most of those cows going to slaughter as well. So there's just not a lot of extra females in the system for a rebuild, let alone an expansion. If we look at our next slide, Jill, we've got a quick look here at what's going on from a feeder cattle and calf supply. The second point is really back to the mantra that most of us understand that have been through cattle cycles before. If we're going to make the beef cow herd bigger, we've got to make beef production smaller to do that. That's taking heifers out of the supply chain from a beef feeding and slaughtering standpoint, keeping them back at the ranch level and making mama cows out of them. Today, some of those are in this beef supply or this feeder cattle and calf supply outside of feed yards. When we look at that number, it's about 25, just short of 25 million. When we think back to 1975, that I didn't include on the chart, but I was just thinking about it, we're half of what we were in 1975. And so we're back to feeder cattle and calf supply numbers close to those of the early 1960s. And that's where the beef cow herd is as well, and the calf crop. There's a lot of things pointing back to that late 50s, early 60s time frame. Yet we're producing probably the third or fourth largest beef production in history. So we need fewer cows to produce more beef. That's been the sustainability kind of trend we've seen over time. But that expansion, we're going to have to take out of already tight feeder cattle and calf supplies to collect another 500,000 or 1,000,000 heifer calves to breed. That decision won't get made till this fall. We already made the decision last year. Those heifers moved off the ranch into the feeding system. They're not going back. So we're going to set this up to be another rally going forward here. Probably not looking like 2015 because we've got tighter supplies yet to come. When we think about that expansion back in the early teens, it had already started in 2010 and 2011, and we were already into bigger calf crop numbers by the time we got to 2013. So we're not in the same spot, and we're going to get tighter if we try to expand here this fall. Our next chart here is what we alluded to from a weather standpoint. The graph here is what we've got from a weather condition standpoint. This is the precipitation anomaly going forward here for October, November, December, recently released from the National Weather Service, NOAA. The darker red it is, the more the drought you've got in the forecast. So that's the transition out of El Nino into La Nina. Drought pretty much in the southern tier of states, all across from the Central Valley and northern coastal range of California, all the way to Florida and the mid-Atlantic. So that is another thing that's really keeping producers kind of on the edge of their seat saying, why do I want to keep heifers now or breed them now when I know that in a year, this ranch is going to be under drought conditions. We're going to have to find more feed and supplemental feed to keep those cows on the ranch. Maybe I'm just better off staying the size I am. So with that, I'll finish with my last chart, which is a quick look at that idea that as we think about where we're at from a market standpoint, starting at the consumer level with retail beef prices, we're about 18 cents below the peak we saw last July and August. So we've seen beef prices come down a little bit. So there's some room above us if we go back into tighter supplies, which we're going to do the back half of this year. The question in the country that we see a lot is, can consumers stick with us and carry more price in the market to continue to push more dollars back into the beef supply chain? So far, we haven't seen producers or consumers transitioning out of beef into pork and chicken, and they're not trading down from a price standpoint either. With that, Brandon, I'll hand it back to you.
Thanks, Dave. Can you hear me? I know my audio was off earlier.
I can. You're good now.
Okay, great. Thanks. I'd like to invite all of our analysts to turn their cameras back on and join us for a Q&A session now. As a reminder, you can submit your questions for any of the analysts with the Q&A feature at the bottom of your screen. We have had some questions come in, particularly with estimates for less wine grape, almond, and walnut acres. What commodities will replace these acres? Any estimates there or guesses? Matt Wolf, maybe you want to comment on that?
Yeah, I'm happy to take that on. Well, a lot of the estimates on total acreage that will be removed due to Sigma is in the 500 to 1,000,000 acre range. That's in the Central Valley. And so that's quite a bit of acreage. I think what will likely replace it is, to a certain degree, vegetable commodities. Although the thing that's important to keep in mind there is that a lot of those commodities easily get oversupplied. We've seen that before in the processing tomato market, where 2017 era was very much oversupplied, too much inventory out there. And so I think that's one possibility. And then I think the other possibility are more traditional field crops that we see in the Midwest as another thing that takes more acreage. And then finally, I think there's a lot of experimentation out there. California agriculture, California producers have always been open to experimentation. And so there's a lot of experimentation with crops like chickpeas, different sorts of beans that are drought tolerant, as well as agave. And so I expect more experimentation with those and that to be part of the scene more and more.
In terms of
Oh, I was just going to say the important thing to keep in mind, though, is, I think it's important to remember this is a shift towards some of those other commodities. And, California will remain a producer of a lot of the commodities it still produces. I just thought I'd add that.
And in terms of wine grapes, I would say this is the $1 million question. What are you going to put in if you pull the wine grapes? Because right now there just aren't a lot of attractive alternative uses. And I've actually heard of some folks putting in almonds. So it's a real challenge today in determining what's going to go in. And I've seen avocados and citrus. There, a variety of different things are being looked at, but nothing looks overly attractive right now, which is one of the reasons that we're probably not going to see the wine grape acreage pulled quickly, because there isn't a very attractive alternative use in most areas today.
Thank you both for that. Jumping back to Dave Weber. Dave, how have nominal per capita expenditures for chicken and pork fared compared to beef?
That's a great question, and it's been an interesting trend since we started maybe July last year through current. When we think about beef spending is about the sum of pork and poultry spending. During the back half of last year, poultry spending or broiler spending was down about 6% from July through December, and pork spending was down about 4.8%. Over that same period, beef spending grew 4%. So we took almost dollar for dollar out of those other two commodities. I think that's a testament to the quality proposition that beef has to offer compared to 20 or 25 years ago, when they really started to address their eating experience and quality concerns, where pork is just getting into that. When we look at consumer acceptance of loin meat, or when we look at what's going on with breast meat and woody breast syndrome within the broiler population, that's had a downward bias on consumer acceptance on both those kind of high value products out of both those species.
Right, thank you. We did have a question come in from the audience. Matt Wolf, to jump back to you, could you speak to why, I guess we could say the majority of nut prices, this question is specific to almonds, why almond prices are still elevated at the retail level?
Yeah, that's a really tough question. We've had a lot of conversations about that with different people in the industry. I think the best explanation there is that a lot of those retailers have seen their prices go up as well. And so you think about the cost of transportation, labor costs throughout the whole supply chain. Those are very much elevated as well. And so I think that's really the main explanation there.
Okay, thank you. We'll jump back with a dairy question for Ben. Ben, could you speak to how have heifer values been impacted by strong beef prices and subdued milk production?
Yeah, I mean, that's been a big story lately, is just seeing how these heifer values and the replacement prices and inventory have shifted. And that's been one of the factors that's limited our ability to grow production, is you've got, in a lot of cases, the option to produce dairy beef cross calves, which are bringing in huge values right now. And that's been a factor that if you're looking at mediocre to not great milk prices, and you can get this other strong revenue stream on dairy beef cross calves, you're seeing more of those calves getting diverted towards the beef side than to refill the dairy replacement pipeline. So that's been a big factor in what's helping to kind of limit our production growth. And I think that as long as we continue to see elevated beef markets, that's going to continue to be a factor. It's going to continue to be an additional revenue stream. It won't last forever, but I think it's becoming a major piece of how these dairy markets work and how farms are managed and operated, and taking advantage of some of these other revenue streams that haven't historically been nearly as profitable. So it's changed things for sure. It'll be interesting to see where it goes, but I think it's going to continue at least through this year and to be an opportunity for a lot of folks. Okay,
great. Finally, Cody, we'll kick it back to you. I know that David briefly mentioned in his presentation about El Nino and La Nina, but do you want to expand and speak a little bit more on El Nino versus La Nina patterns?
Well, not a climatologist, but El Nino for the Southern Plains would be a wetter climate. The La Nina, we're headed into a drier climate, like Dave's slides pointed out. I will say being in the Southern Plains, we didn't feel much of a El Nino. We have been in the drought area for 28 consecutive months. The Western Kansas is in a very difficult place from a hard red winter wheat production standpoint. Again, this year, this would be the third year in a row. So all of these factors are going to be playing into the market. But from a price perspective, especially when we look at corn and soybeans, I still like to keep in perspective how good the genetics have gotten. I think back to last year when we were in such a difficult situation in the corn belt from a dryness standpoint, and the corn was rolled up like a pineapple, and yet we produced 177 bushel per acre on the national scale, which is a new corn record for us. So I just like to keep that in perspective and manage pricing opportunities when they do show profitable levels and not bet too much on long-term weather forecasts.
Okay. Thank you. Well, that looks like all the questions that we have for today. If you have any additional questions for any of our analysts, you can reach them at terrainag.com. Additionally, be sure to opt in for our notifications of the new content releases at agown.com/terrain, where you can opt in for those email updates. Before we depart today, as we have customers and captive audiences, we do like to let our customers know that we are moving our patronage system to a direct deposit system. Normally, our customers receive their patronage payments via check, but we are rapidly adopting the digital experience. And so we are asking customers to opt in to receive their patronage earlier and more securely with direct deposit. So I've gone ahead and put in the chat the link to be able to input your information for that opportunity. And with that, we thank you for joining us and have a great rest of your day.